Hello everyone. Good morning, good afternoon, wherever in the world you are, and welcome to today's webinar on what effective climate-related financial disclosure looks like. Over the next hour, we'll discuss how to prepare disclosures for the benefit of investors, while also clarifying some common TCFD implementation challenges and offering examples of good practice. Before I introduce you to your speakers, I just want to ensure that everyone can hear me correctly. If you are having any audio connections, do drop me a line using the chat or the Q&A function, but hopefully it should be all loud and clear now as we have troubleshooted some of those issues that we experienced early on. Excellent, all seems good. So as mentioned, I'm thrilled to introduce you to today's speakers. Fiona Quinlan joined CDSB's technical team in 2019, having spent 6 years working in corporate sustainability reporting and strategy. During this time, she worked at Carbon Credentials as well as for the energy company Centrica. Jane joins us from Ørsted and has until recently been the lead researcher for the Centre for ESG Research. She's also part of EFRAG's European Lab PTF on climate-related reporting and sits in the technical working group here at CDSB. So safe to say we're in very capable hands for today's webinar. My name is Leslie McKenna. I'm the Communications Manager here at CDSB and I'll be your moderator for today. So before we begin, I'll quickly talk you through some housekeeping. We'll host a questions and answers session after the presentations. So we encourage everyone to submit questions using the Q&A function. You can activate this by clicking the 3-dot icon on the bottom of your screen. This will open up the Q&A function on the right-hand side. Please do submit your questions throughout the presentation. You don't need to wait until last minute. And before we dive into the presentations, I do want to confirm that we will record today's session and distribute a copy of the recording and the slides afterwards. And now I would like everyone to participate in this short poll. So the question we are asking is, what is driving your interest in implementing the TCFD recommendations? I'm going to open the poll now. And you can choose from A, B, C, or D. So A, investor demand, B, changing regulation, C, becoming part of your strategic planning and risk management processes, and D, desire to align with peers in your sector. We also ran this poll during the morning's webinar, so it'll be quite interesting to compare the results and see how it differs between the different regions. So we will leave the poll running in the background for the next 2 or 3 minutes, and then we'll reveal and discuss the results after the presentations. So with that, it's my pleasure to pass you over to Jane, who's going to take you through investor-friendly TCFD disclosures. Thank you, Jane.
Thank you so much. My name is Jane, as mentioned, and as also mentioned, I'm part of the technical working group at CDSB and also member of the EFRAG European Lab on climate-related reporting. And it is especially the latter where I will take you through some results of some research that we have done at EFRAG, which hopefully will be inspiring for you. And next slide, please. Thank you. On this slide, you will see the overall results we made at EFRAG when we looked into how is the current TCFD reporting with regards to scenarios, which was the subgroup I was part of, where we looked into how is that reported currently. It is fairly early days with the TCFD reporting, so we might see some elements which are not there. And one of them being that scenario analysis is the area where we see most companies having challenges. Most companies do not currently report on scenarios, at least not yet. We can also see there is an emphasis on transition risk. If they report on scenarios, that is on transition risk, whereas fiscal risk is more rare, you could say. One of the other things that we noticed was that there is a conflict on time horizons between the impact from the climate change and usually how the financial planning and strategy is made. So usually you will see that climate change is usually quite long. Usually it's something like 10 years and stuff, whereas with your financial planning and strategy, it's usually 1 to 5 years. And that will also be an issue if you try to align your TCFD reporting with the IFRS rules on impairments and provisions, that it's often shorter. Does not necessarily have to be, but often shorter. And there is some conflict here that we need to look into to be sure that that this will work in the future. Then we can also see quite significantly, actually, is that there is a lack of data in tables. There are many illustrations. We can also see that often are the scenarios provided outside the mainstream financial report. And that is, of course, a problem. As you know, the TCFD, the FD means financial disclosure. So to put your TCFD report outside the mainstream financial report is really not the best idea. Then we can also see there is a lack of comparability because each and every company invent their own ways of reporting. And that makes it really difficult for the investors to use it. There are often a lack of assumption clarifications when the reporting is made, and there is often not a reference to the scenarios which are considered, whereby the investor could actually aggregate to a portfolio level. That means all the investments they have or consider to have, they would like to compare and they would like to be able to aggregate to the entire portfolio and thereby see what is actually the real risk profile for my investments. And that is not possible today because it's very, very difficult. And then, of course, on top of this, if the company is only using illustrations, as you can imagine, it is really difficult to aggregate illustrations. So that is something to consider at least. Next slide, please. On this slide, I would like to go a step deeper because one of my favorite topics are quantification and monetization of scenarios. And I would really like to highlight how we looked into this. And we had a quite large outreach to both preparers and users of the scenarios to try to figure out what they thought of the results we had found. And what we saw was that it is really problematic that the scenarios are rarely quantified. And it is even rarer that they are monetized. But when we talk to the preparers, they tell us that it's often a trade-off they have to do between the transparency and competition they have. That is quite common, comment on that. We also see that in some jurisdictions, especially the reporting on opportunities, can be a litigation issue. You cannot tell your investors about something that might happen, which is really good for the company, and then when it does not really evaluate that way, then it's really difficult to explain that that was just a scenario. It was not a promise. So you might have some litigation issues on that. And then finally, also for the preparers, they indicate that there is a lack of good standard input data that they can use for their scenario work, and that really makes it hard for them to do the scenario work. And that is also a very fair point to state. From the user perspective, we see that given that there is limited quantification and monetization and transparency about the assumption, it makes it really difficult for them to use it in their analysis currently. We also see that they raise that there is a lack of alignment to the financial statement. So the information is often quite problematic because they might even be in contradiction with what they see in the financial statement. That is difficult for the investors to actually absorb, that you can have two different ways of communicating on this. that is another argument for having the TCFD reporting in a financial report. And finally, they also indicate that it's really helpful for them if the scenarios are reported year to year, because then it's more easy for them to actually compare data with trend analysis and compare one company to the next. So that's quite important for them to also have that. But as I mentioned, overall, the problem is it's not quantified, and even rarely it is monetized. Next slide, please.
Jane, just before we move on to the next slide, we're hearing you loud and clear, but there seems to be a small little bit of static coming through sometimes. Would it be possible for you just to adjust the microphone ever so slightly, and we can see if that can resolve the issue?
Yeah. Is this better?
Yes, that sounds
okay.
Thank you.
I have chosen a couple of good examples from when we made the analysis. And the first example I've chosen is this one from Equinor. Equinor is the Norwegian oil company, or they will probably say energy company. They have actually two ways of reporting on TCFD. One of them being in their sustainability report, and that is the one you see on the left side, where they show the net present value of the portfolio of oil fields. And you can see here that they have tried to make some stress tests of with the current policies and new policies, and they try to look into what is the impact from that. That is one way of looking into this. But the other side, I'm not entirely sure Equinor recognized this as their TCFD reporting, but actually it is really, really helpful for the investors. And that is that they have this sensitivity analysis, which indicate what is the impact when you change the oil price, what is the impact when you change the gas price and the currency and stuff like that. That way of looking at it is actually a very, very helpful way of working with TCFD. Because in this way, the investors can actually normalize the data and they can aggregate it. Of course, it's made also here in graphics, but it's actually possible to also detect the numbers. So it is actually useful for the investors to use it this way. But really interesting to see that they have two different ways of working with the sensitivity analysis they do. Next slide. Another example is from the financial sector, which is AXA. And they have made a climate report where they have looked into what the net climate cost impact is on the allocated assets they have. And here they have looked into what the transition cost is, the physical risk cost is, and the green revenues they have, and company cost of climate. That is one way of looking at it. And then they have also, and this is quite rare, then they have also looked into what the exposure is on various markets they have, given physical risk from floods and windstorms. And that is quite interesting also to see, and quite specific per area. That is also a way of working with the quantification of the scenario reporting. Next slide, please. I've included this one. This is not a real reporting. This is a model we created, I and CDSB, back in 2018. And it has actually been taken up by MIT as well. This is a guide where we try to show to you how could you actually make investor-friendly scenario reporting. And it's a two-step way of working with this. The first thing you should do is to look into what factors should you consider when you do your scenario. And here you can see out of the x-axis, we have the impact on and the magnitude to the company. And then on the y-axis, you have the time frame. And in that way, you can look into what is really relevant and what is not. And you can see if it's really not impacting on the company, then potentially that is not something you should consider. And then you should also consider what is the time frame of the impact from various factors. Here we have included the change of taxes and the direct emissions. We have included, for instance, flooding of fields. We have included reduced energy cost. This is an opportunity you could consider. Or it could be something like reduced market for used fossil fuel vehicles. If you have a lot of those vehicles, it might be an issue because you will potentially have to impair the fleet of vehicles. And here you can see that you quantify the input and then you monetize the output. And in that way, it is actually possible for the investors to normalize the data and to be able to aggregate to a portfolio level. And you can also see that the scenario reporting is done for the coming year, for the next 5 years, and the next 10 years, and it's accumulated. And that way, the investor can also see what is the time span here for the risks and opportunities that the company is facing. So that is a really tangible way of working with the scenarios. I would say if you were to do this, I would really recommend that you bring to the table both your financial and non-financial people, because they can inspire each other with ways of working with this. So this is a quite useful way to work with it. And as you could also see, especially the reporting from Equinor, they also have this logic around that you have an input and that brings you an output. So this is something that your financial colleagues might very well be able to understand immediately. So I would really recommend that you do it this way if you are have any doubts about how to do your scenario reporting. Next slide. This is just something you can use if you want to read more. There is a link to the EFRAG report where we have shown a lot of good examples of TCFD reporting, not just on scenarios, but also other elements of the TCFD reporting. So you can see it here. And if you want to know more about the model I showed you lastly here, you can go into either CDSB or the MIT reporting, so you can see it here. That was it. Thank you.
Thank you very much, Jane. And we've had some great questions come through already, so please do continue to put those into the chat function, and then we'll hear from Jane again during the Q&A session. So with that, I would like to now pass you over to Fiona, who's going to talk us through some of the common implementation challenges of TCFD and offer some guidance in overcoming these. Over to you, Fiona.
Great, thanks, Leslie. And can I just double check I'm coming through okay to you now?
Yes, we can hear you loud and clear.
Perfect. Always good to check. Great. Thank you very much. And thank you, Jane, for that really interesting presentation. Some great examples and advice there. And I think that leads us on well to what I wanted to cover, really. So here at CDSB, we're often asked, how do I know when I've met the TCFD recommendations? Or what constitutes an effective TCFD disclosure? So what I wanted to take you through today was an overview of some of the common challenges and misconceptions that we're hearing from the market, and consider in turn how these might be tackled. So once we've tackled these, this will then lead us to a complete TCFD to-do list, which ensures that we're producing effective and reliable climate-related financial disclosure in line with the recommendations. So before we dive into this, I just wanted to provide a brief reminder for those who perhaps aren't familiar with CDSB of who we are and what we do. CDSB is a consortium of environmental and business NGOs. We were set up in 2007 at the World Economic Forum in Davos, and our secretariat is hosted by CDP. Our mission is to provide decision-useful environmental information to markets via the mainstream corporate reports, and we achieve this by offering a framework for reporting environment and climate information in the mainstream reports. Next slide, please. So the CDSB framework, which you can see summarized on the slide there, provides a set of 7 principles and 12 requirements covering both the how and what of environmental disclosure for companies. The framework is fully aligned with the TCFD recommendations and its 7 underlying principles, and it's also complementary to other reporting provisions such as CDP, GRI, SASB, and existing regulations. So with introductions out of the way, I'm now going to take you through our effective TCFD disclosure to-do list. So you'll see the to-do list summarized on the screen there in front of you, which we've just released online today. So this has been designed to help you address some of the common disclosure challenges we're hearing about, and in doing so to improve the effectiveness of your disclosure. So I'll now take you through each of these 9 points and provide you with some examples of companies who are doing these things well. Great. So one of the most common misconceptions that we hear is that information can be disclosed in a separate TCFD or sustainability report. But as Jane's already said, the TCFD recommendations themselves did say that material information should be provided in the mainstream report. And when I say mainstream report, I'm referring to the annual reporting package in which the company delivers its audited financial results. This is often referred to as the annual report and accounts, or in the US, the Form 10K. So why should climate-related information be disclosed in the mainstream report? Well, this is the location where the company's core communication to investors is, so material climate information should be disclosed in the narrative and reflected in the numbers to support well-informed investor decision-making. If it's placed in other documents, it will probably be harder for investors to find, and it may not be considered in the context of the company's wider strategy and performance. Additional disclosure, which, for example, might provide further detail or supporting information, could be located in supplementary reports, provided that a concise summary is put in the mainstream report of what is material. So an example that we point to of an organisation doing this well is Shell. So Shell produced quite a concise summary within their mainstream annual reports of their TCFD disclosure, covering the core recommendations. And they then provide clear linkage out to other sources for further detail. So they link out to their energy transition report for details on the scenario analysis work, but do provide a summary of this within their mainstream report too. Next slide, please. So another challenge that we often hear about is that investors don't consider company reporting on climate change to be of the same quality as financial information, which limits its decision usefulness for investors. So it's therefore important to ensure that the same rigor and management responsibility is applied to climate-related financial information as is applied to financial statements in the mainstream report. So whilst independent external insurance is not necessarily a requirement, information should be prepared as though it would be assured, undergoing the same or comparable internal controls as governance procedures as financial disclosures. So the application of similar internal controls as for financial information can also help to address some of the other disclosure challenges that we commonly see, such as confusion over materiality, as this is a key aspect of financial control processes. So for further information on how to achieve this rigor, we'd recommend that you consider the guidance released in 2019 by the World Business Council for Sustainable Development alongside the Danish auditor FSR. So this guidance, as you can see on the screen here, provides a process to undertake a gap analysis of your existing controls environment, as well as practical steps for how this could be strengthened, which aligns to the COSO International Control Framework. So now turning to our next challenge, another common criticism we hear is that company disclosures on climate change might be of a boilerplate nature. So that's to say they're not sufficiently specific to the company or its particular circumstances. So generic disclosures of this kind are not helpful for users of reporting. So for example, if risks and opportunities from climate change are only mentioned and discussed at a societal level without being linked back to the industry or business in question, this isn't going to be meaningful information for investors. So in order to make sure disclosures are specific to the reporting entity, they need to be complete, they need to be focused on major trends and events and specific to that organisation in doing so. So where possible to support this, try to keep them free from immaterial clutter or kind of duplicative detail that could obscure the ability to find this important contextual information. So an example we point to of good practice on this element is EDF. So within their disclosure, they talk about not just climate change risks at an aggregate level, but they address how this might affect specific areas of their business. So for example, they take in turn their operations, their products and services, and their investments and acquisitions to help provide a contextualized view of how they integrate climate risk into these different aspects of their business strategy. Next slide, please. So moving on to our next point, ensuring that climate-related information is well linked to other financial and strategic information in the mainstream report is another commonly cited challenge that we see. So to be effective, disclosures need to be connected and coherent with other information in the mainstream report. So for example, try to consider how your business's strategy is impacted by climate-related risks and opportunities, and bring this out in both your main business model disclosure, but also the numbers that you report in your financial statements. Climate-related disclosure needs to not be standalone and needs to be provided in the context of this kind of information. So a simple way by which you might start to do this would be to provide page references which link between the different sections of your report, and then over time you could move to greater integration of narrative and quantitative aspects. So a good example that we just showed here is Schneider Electric. So specifically what we liked about Schneider Electric's disclosure is that they, alongside reporting environmental metrics that we might be more familiar with, such as renewable electricity or greenhouse gas emissions, they also try to use metrics which link more closely to their business performance. So Schneider themselves provide environment and sustainability services. So they also disclose information on the revenue they're gaining from these services, which helps to provide a more integrated view of how climate change and financial performance are linked for them. So another potential misconception that we encounter is that the sustainability or CSR department should be responsible for implementing TCFD. So whilst obviously they may have an important role to play, it's vital that you get buy-in from across the business with leadership input and accountability from all of the relevant functions. And that in itself will help to lead to integrated disclosure. So a key way this can be demonstrated is through your governance disclosures under TCFD, enabling you to illustrate which individuals and committees at board and management level have responsibilities regarding climate change. So some good practice examples we'd like to talk through here include the Italian company Enel and the Royal Bank of Canada. So here we've just provided a brief excerpt from Enel's disclosure, which you don't need to read, but just to kind of give you some context to what I'm talking about. So here they talk about two different committees within their organisation, which both have roles with regards to climate change. And they take each committee in turn and state specifically what its role is, and then give examples of the types of activities it might do. So for example, the Corporate Governance Committee has responsibility for examining climate-related targets, and the Control and Risk Committee is responsible for approving non-financial reporting. They then, in further detail after this, also provide clarity on different business functions and different regions they operate in, and how climate risk and governance is considered for those areas too, which is really helpful. And just turning to the Royal Bank of Canada, theirs is a briefer disclosure, but they provide quite a nice, concise summary of the board's oversight of climate change, which explains the different functions that are involved in the processes feeding into the board. And then they then tie these responsibilities back to the management level performance goals, showing how this is more embedded in the organisation. So our next point relates to qualifying the completeness of disclosure. So although we're seeing more organisations providing reporting, a common challenge is still that this information might not be complete, and the level of transparency around this can be limited. So for example, in the TCFD status report in 2019, they found that on average companies were only making 3.6 of the 11 recommended disclosures by the TCFD. So an important aspect is providing a clear statement of conformance with the recommendations. So this provides transparency over the limitations of current information and helps to show where disclosure gaps are being addressed in future. Ultimately, investors are going to be quickly able to determine what information is missing. So failing to acknowledge this doesn't necessarily do you any favours. And this would be in keeping with the 5-year implementation path that was set out in the TCFD, which recognised that fully aligned disclosure was going to be an iterative process that took a number of disclosure cycles. So the important thing here is really just to ensure that your disclosure demonstrates continued improvement in transparency over time. So a good example to take a look at here is the Australian insurer QBE. So you just see a summary on screen here of the roadmap that they included in their most recent annual report, which shows both the historical progress they've made year on year in addressing the TCFD recommendations and what their plans are over the coming years to rectify any existing gaps. So this is a really helpful level of transparency to provide in your disclosure. And just moving on to our 7th point. So here we say about providing forward-looking information. This is something that we know can be quite challenging, but really is a key aspect of TCFD. So a starting point to support this could be to look at your existing historical disclosures and just start to add a little bit more narrative around how you think this information might influence your future performance. So disclosures need to try and look to the future and think about the trends and factors relating to climate change that are going to affect your performance, position and development over time. Ultimately, this is about showing that your business is resilient to future climate risks and well placed to capitalise on opportunities. So it's important that you make sure that that time horizon is stretched out to look over the longer term, and that you're clear what you mean by longer term as well. So I think it ties in quite well here to Jane's point, specifically to scenario analysis, but also applies more broadly, is that another area of challenge we see is that tackling how to be transparent around the financing that links to your climate change strategy. So an example here would be that we see companies in high impact sectors such as oil and gas now able to provide stronger disclosures on their narrative side around their business strategy. However, where we're perhaps still seeing failings and gaps in disclosure relate to the financial planning aspect. So they may be able to speak about the low carbon opportunities in their business model, but this isn't necessarily transparent in their capital and R&D investments. So supporting your narrative reporting on climate-related matters with illustrations for your investors of how you're executing this in your strategic and financial plans is really key, and ultimately helps to ensure that you're demonstrating that you're putting your money where your mouth is. So I think this is a really key aspect in terms of that integrated approach to disclosure, where not just the sustainability team should be addressing this, but you should be working alongside colleagues in other functions to ensure that integrated view of financing and strategy. So this brings us round to the final points in our to-do list, which I think really encapsulates and brings together themes from all of the others, and that's around decision usefulness. So really what's important is to ensure that the main users of your annual report, so that would be your investors, lenders and insurance underwriters, are able to integrate the information they need on climate change into their decision making. So useful things to think about here are how people read your report and making sure that simple things like keeping the format succinct and clear and consistent over time are there to help users find the information. It's also a good idea to think about the metrics that you're reporting and whether those are consistent with those widely used for your sector. So, for example, the reporting boundaries that you might apply and whether the intensity metrics you use are consistent. So, are you providing intensity by revenue or intensity by product output for carbon emissions, for example? So, a useful tool in this regard might be the CDSB standards. So CDSB have developed a set of 77 industry-specific standards which set out financially material sustainability topics and associated metrics for a typical company in a range of industries. So I'd really encourage you to take a look at these to help get you started in this area if it's something that you'd like to know more about. So that concludes the TCFD to-do list. I hope that this provides you with some helpful suggestions as to how you can overcome some of the key challenges and misconceptions around the TCFD and thus enable you to provide more effective disclosure over time. So I'll now hand you back to Leslie for the next part of the session. Thank you.
Thank you very much, Fiona. And we have had a couple of questions come in regarding examples of US-based companies. So I think this slide is actually quite useful to signpost you to some resources where you can find more examples of good practice reporting. So the TCFD handbook, which you see on the right-hand side, CDSB developed this in partnership with CDSB, and through that we take annual examples of annual reports from across the G20. So examples of US companies that spring to mind there are the likes of Kellogg's. So definitely do head over and look at the handbook. But we might come back to that question as well during the Q&A with Jane and Fiona around maybe some examples or thoughts they've had on US-based reporting using 10K reports. Also, the TCFD to-do list, which Fiona mentioned, is now available to download on the CDSB website. And also we encourage everyone to visit the TCFD Knowledge Hub, which is a database of case studies, white papers, examples of company reporting, and these are collated globally. So you can definitely find examples of good practice and how other companies are approaching TCFD disclosure from across the globe. And we also launched at the end of last year the e-learning courses on the TCFD Knowledge Hub, which focus specifically on climate-related reporting. And then also just two other webinars that are coming up in May, which may be helpful to the audience. The first is on the 13th of May. CDSB are launching a new guidance with CDP on the building blocks for successful TCFD disclosure. And then on the 19th of May, we are launching an analysis of climate and environmental reporting by Europe's 50 largest countries. So appreciate this may not be as relevant for some of you who are based in the US, but also can be quite interesting to hear how your peers are approaching disclosure. So while I'm gathering the rest of the questions, I think now would be a really good time to launch the results of the poll. So for those of you who may have joined a little bit later, we did run a poll at the start asking what is driving your interest in implementing the TCFD recommendations. So I've launched the results. So investor demand, 50% of you voted for that. Changing regulation, 15%. Part of your strategic planning and risk management processes came in at 48%. And then D, the desire to align with peers in your sector, came in at 25%. So quite interesting that both A and C were quite similar in ranking. Jane or Fiona, would you like to provide your thoughts or comments on the findings and whether you find them surprising, or is that in line with what you would have expected?
Yeah, I can make a start if you like. I think, yeah, it's really interesting to see that's very consistent, Leslie, with what we saw on our this morning's webinar as well, where we had quite an even split between those seeing it as an investor-driven rationale and then those who were kind of looking at it as a strategic tool. So I think that's quite consistent with what we saw earlier. And I think, as I mentioned then as well, I think it's positive to see that as well as that investor demand kind of feeding through to companies' action in this area, it's also something that companies are taking on themselves as an opportunity to improve their own climate strategy. So I think that's quite positive to see.
Yeah, if I am to say anything on that, I would say it's really positive. You could say that the investor demand is actually that high. That's really great. Usually when I'm out and talking to CFAs, then we talk a lot about how they can actually push this agenda quite well if they at the annual general meetings or at the capital markets days actually start asking questions about this, that they actually so that the CFOs who might not necessarily be a world champion in TCFD will have to run back to his organization and ask, what is TCFD? What is it that we did not do? Why do we not report on any scenarios? Because apparently the investors want it. So, so really great to see that the investor demand is that high.
Fantastic. Oh, thank you both very much. So that does bring us to the questions round, and one of the questions does relate back to our poll. So there's a question around changing regulation, and do we expect to see mandatory disclosure related to the TCFD in the future? What's your take on that, Jane or Fiona?
Maybe. At least in Europe, there is some talk about that the non-financial reporting directive will include also mandatory elements, and that might also include some TCFD elements. Whether it will be on scenarios, that I'm more uncertain about. But let's see. Let's have hopes.
Great. Thank you very much, Jane. Fiona, did you want to expand on that before we jump to the next question?
Yeah, no, I think it's a good point, and obviously, yeah, it's perhaps seen as a lower driver right now because it's perhaps at the stage where a lot of regulators are letting the market practices be established and then considering how to move. So I certainly think that will evolve, and we've seen moves in that regard in a number of jurisdictions already. So the UK's Green Finance Strategy, for example, committed to assess that area and expected companies to disclose by 2022. And in the EU, the non-financial reporting directive is currently being reviewed to consider its revision, which may potentially lead to greater adoption of TCFD within that piece of legislation. So that's just two examples from many in different jurisdictions that are progressing at the moment. So yes, I think it's certainly an area to watch and one that will be evolving. So something to get on top of now, rather than necessarily wait for that regulatory burden to come in down the line.
Brilliant, thank you, Fiona. And I think that it is good advice, trying to get ahead before it becomes mandatory. Jane, we'll bring you right back to your presentation, as this question came in while you were presenting. So the question is, are there any industry standards that look at kind of impact on or magnitude to the company? Otherwise, how can investors really analyse across companies?
It's a really good question. And currently there are, just as there are no mandatory TCFD reporting, there are no standards for the sectors currently. But if you look into the short guide that I presented to you, you will also see at the very end of it that we have suggested some standard risk factors that the companies at least should consider. And in that way, for instance, all should probably consider what is the impact on our company if the CO2 taxes are increased by, say, $10 or £10 or €10 per barrel. Will that impact on us, or how does that work? That, I think, will be tremendously important if we had such factors which are standard, because I totally agree with the question that it might be difficult to aggregate if we do not consider the same factors. But then again, as I also mentioned before, if you are an investor and you would really like that the companies are reporting in a certain way, raise your hand at the AGM or at the Capital Markets Day and ask, why did you not consider this and that? It's the only way to move it.
Brilliant, thank you. And as I said, we will be distributing the slides afterwards, so you will have access to those links and be able to view the guidance in more detail that Jane touched on. So we'll move to another question that came in during Fiona's presentation. Could you explain again in a little bit more detail what you mean by qualified disclosure?
Sure. So I think going back to what I was presenting here, this is really just about being transparent around where the gaps are in your disclosure. So I guess that in that sense is qualifying the quality and completeness of your current disclosure and clarifying where there are gaps perhaps that you might be working on. So I think that kind of speaks to the point I made from the TCFD status report, that there were quite a lot of companies who perhaps had selected elements of the TCFD framework to incorporate into their reporting, but had perhaps, for example, not addressed scenario analysis and maybe haven't acknowledged that. So I think all we're really looking for here is that the reasons for not having disclosed scenario analysis yet should be qualified. So it's perfectly acceptable to be transparent and to say, look, this is a newer area for us and it's something that we're going to need longer to address, and this is our plan to do that. But it's really just about providing that qualification on where you are in your disclosure journey and how you intend to address that over time. Hopefully that helps to clarify.
Yes, excellent. Thank you very much. And Jane, from your perspective in terms of investors, we speak about the information having to be investor grade and decision useful. Is there anything you'd like to add in terms of what you would expect a qualified disclosure to include?
Well, it really have to be in good nick, and the trouble is often that that qualification are not necessarily understood by the investors, because there are several levels of qualification. Sometimes when you have what is known as limited review of your data, the investors may not understand what that is compared to having reasonable review. So there is also some education of the investors to understand what is it actually you're looking at, what is the quality of the data that you're looking at. So that is also quite important, actually.
Excellent. Thank you. I am conscious as well of time, and I don't want to hold up our wonderful speakers and our attendees too much longer. So I think we've time for just one more question, and it relates, Jane, back to your point around bringing together the financial and the non-financial teams. And actually, this is something that comes up quite frequently in our webinars and when we host workshops with companies. And it's about getting that buy-in, or helping teams to collaborate together. So is there any specific advice that you can give to our audience around helping teams work together more? Or, for example, if the financial team doesn't think TCFD is a priority, how do you get them on board and manage those, I suppose, competing priorities across teams?
Well, actually, raising some of the risk factors, some of the more severe risk factors, and raising those to financial people, they will usually understand that this could potentially have tremendous impact on our future economy. So it is potentially a matter of that the non-financial people are well prepared when they approach the financial people and tell them, you actually have to look into this because this might happen to our company. And also potentially take out some of the more nitty-gritty elements which are important from a CSR/sustainability point of view, and then solely look into what is important for the company per se, because that is the traditional way of looking at things from a financial point of view. So potentially also consider that the risk assessment you are to look into is a matter of how will this impact on our company if this happens, because that is how they think. And usually that is the contrary as what sustainability people think of. They consider how will we impact on the surrounding of us. So there are some differences, ways of thinking that you need to consider. But it is my experience that once that co-work is starting, it is actually very helpful for both parties. It turns out also from more generic controlling of data, of the ESG data, is actually that both parties gain something from this work. Because on the one side, you have that, of course, the ESG data get of better quality, but also, and this is quite important, also the financial data, because you will be able to also identify if you need to, for instance, impair some of your financial assets because there might not be a market in 5 years for fossil fuel vehicles, for instance, and they had not thought of that. So you might impact each other's worlds quite enormously, and it is important to do that. But I do know that it's a hurdle in some companies. So if I were the non-financial person in that company, prepare some scenarios where you foresee this will have tremendous impact on our company. Then they will listen.
Great advice. Thank you, Jane. And how about you, Fiona? Anything else to add to that?
Sure. I think those are all really helpful points. I guess the only thing that maybe I'd add would be around just doing your homework really on that angle that will work most effectively for different kind of functions and stakeholder audiences. So really coming prepared with whatever rationale you think will resonate most strongly, whether that be the number of your top investors that have showed support for the initiative or already providing disclosure themselves, or something of that effect. So one thing I think that we found quite helpful is that a lot of the different professional bodies in related disciplines such as accountancy, risk management, are extremely supportive of this area and have published a lot of their own work on this regard. So if you're going to speak to financial accounting teams, probably looking at what the different chartered accounting bodies are saying on this might be a helpful piece of ammunition, or the same with risk professionals as well. So yeah, I think just thinking kind of clearly about what the best angle is for the different function that you're trying to engage, and as Jane said, thinking really about what's in it for them and kind of the opportunities it presents as well is a really good way to go. But yeah, for sure, as Jane already said, it's not easy. So I think it's really about just thinking through what technique will work best in your specific context.
Great. Thank you very much, Fiona. Well, that does bring us to the end of today's webinar. If we didn't have an opportunity to address your question, please do reach out to us directly at info@cdsb.net, and I can send your question to the relevant person to get an answer for you. So I would like to thank our fantastic panelists for sharing their insights today, and also to thank all the audience members for joining us, for listening, for participating in the poll and putting forward your questions. I wish everyone a wonderful day, and I hope to see you on future webinars. Bye-bye.
Bye.